All right, my friends, life insurance policy with a long-term care benefit rider, R-I-D-E-R. It has always got to spell that out, so it's a rider, which is like an attachment to the policy you're talking about. Subscriber Deb, let's call her Deb, shall we? She sent me an illustration of an offer of, an illustration of a long-term care rider attached to a life insurance. You just want to know my thoughts on it. So let's go into this. I talked a little bit about yesterday on the live stream, but let's talk about it. So Miss Deb, and she's 59 years old, and she had $22,000 is her premium. Now what that means is that's called a drop-in, which simply says you're going to drop in $22,000 and never pay another premium. Now you can, but a drop-in means it's not be a monthly, it's going to be a drop-in. I'm just sending you a check, insurance company, for $22,000. So if she's 59 years old, actually I'm not sure her health status, if she smokes or anything. I forgot to ask her, but let's presume she's in okay health. I frankly just don't know. Probably should have asked, but I don't. Anyway, so she's 59 years old. She has a $22,000 drop-in, which will give her $100,000 life insurance. All right, so if she dies, her heirs will get $100,000. So we know for a fact she'll get roughly 5 times what she put into the policy. Well, obviously she won't, but her heirs will. Does that make sense? So if she dies tomorrow, her heirs get $100,000. She dies at 90 years old, her heirs get $100,000. Now the issue is this will expire at age of 97. Just keep that in mind, which brings me to something else I definitely want to talk about. But anyway, if she lives beyond 97, she's going to have to drop more money into it, and that's the thing with all life insurance policies. I don't like those life insurance policies I'll talk about here in just a second. All right. Well, anyway, her contingent isn't because she's single. I don't think she has any kids. I don't think she has any heirs. She wants it more for the long-term care provision, more so than the life insurance. But she likes it. Maybe she did have kids. Maybe she's divorced. I can't remember. But anyway, she liked the idea that if she does die, someone, maybe SPCA, someone, maybe YWCA, will get $100,000 life insurance for her $22,000 premium that she put in there, which is essentially 5-to-1 ratio, which is pretty good. Now, there's a 4% long-term care insurance rider. And what I can't really read that, can you? What that means is if her doc says she has 2 of the 6 ADLs that she can't perform on her own, the activities of daily living, if she can't perform 2 of the 6, and they're like bathing, transferring, toileting, and I forgot the other ones, but there's basic stuff. I mean, you can't do this. The big one, actually, which is relatively new to me, is you can't get up off a couch and transfer. You can't pivot. That's transferring. If you can't do that, you're deficient in one of the 6 ADLs. You can't bathe, you can't eat, you can't transfer, you can't toilet. You need help with this stuff. If her doc says she needs help with 2 of the 6 ADLs, activities of daily living, what will happen is she can then take 4% a month off this death benefit, which is $4,000, $4,000. So that's $4,000 a month for long-term care until the death benefit is exhausted. $4,000 a month, and so that would be times 12. That's 48 months. That's 48K, and then times 2. So basically, she has 2 years of long-term care insurance coverage. So $4,000 a month is 4% a month is what she could get. All she needs is a basic doctor's written slip to say, look. And it's not reimbursement. Oh yeah, that's another thing I want to talk about. This is actually cash money. You're not being reimbursed. You're getting cash money. So they give you the check and you do whatever you want with it. The old days of long-term care is you had to file the receipts to get reimbursed. That was a freaking nightmare, man. I remember having some people go through that. I was like, that's nuts. This one is just cash. You get cash. So they say, okay, the doc says you got 2 of the 6. Here's $4,000 a month until this guy is wiped out. Does that make sense? Now, if she has a terminal illness, she gets 75% of this as what's called an accelerated death benefit. That means she say, hey, you're going to die within the next, I think it's 12 to 18 months in this policy. We'll cut you a check for $75,000 to go enjoy yourself, essentially, which is pretty cool. So in this, you got three different things. You got a $100,000 death benefit, you got a long-term care, and you got a terminal illness provider. And that still is going to grow some cash value. So let's just say 10 years from now, you don't like the insurance company, the lady who sold to you is a loser, blah, blah, blah. You say, yeah, I don't want this anymore. Send me a check for my cash value. And they'll do that. Now, I don't know what the cash value will be at that point. I just don't know. It may or may not be worth $22,000, but that's pretty good. And that's a life insurance with a long-term care rider. I'm a big fan of that. Now, as always, you got to say, well, what's the opportunity cost of not investing that $22,000 because I don't have the $22,000 anymore. The insurance company has it. So let's talk about that. So basically we got, in this case, $22,000 gives us the equivalent of $48,000 a year for 2 years in life insurance and long-term care. So let's say you say, well, forget that. I want to take the $22,000 and I'm going to invest it for 10 years. I'm going to get 6%. Oops. 10 and 0 payment. That'll be worth $39,300 in 10 years. So you got $22,000. In year 10, $39,393. Year 20, I remember she's 59 here, should be 69 there, 79 there. That's at 6%. So it's not, we're not swinging for the fences here. Let's go 6%. 6%. Hold on just a second. 10 years in. Oops. So we got 22,000. Present value zero payment. 20 years, 6%. It'll be worth $70,550 in year 20. When she's 89, year 30, how much would that $22,000 be worth? Let's take a look. $126,000. Now that's the at the end of the day, if we were to invest that, let me just make sure I got my numbers right. $22,000, present value, zero payment, 6% interest, 30 years, compute future value. Yeah, 126. So in this case, it'd be better to have this right here than it would be to have the $100,000 of life insurance with the accelerated death benefit or the long-term care rider where you can take 4% a year out, because here you got $126,000, and that will give you basically about 2 3/4 of a year for long-term care, where the other thing would only give you 2 years. Does that make sense? But what happens in these years? All right, and this is why I have long-term care myself, because the older years I'm not as worried about as I am the younger years, because in this case I have 20 years, which I don't have nearly enough to cover me for long-term care need. I just don't. Now the facts are, the older you get, the more likely you're going to need it, which is why it costs more as you age. But I mean, that's the challenge you're dealing with. If you need the long-term care at 75 years old, you're not going to have 70. You're going to have $60,000, where the other one you have access to almost $100,000. You see what I'm saying? That's the drawback. So I don't know. It's like any insurance thing. You're not going to get the best of both worlds, which is good growth and low insurance. You're just not. You're going to get one or the other, which is usually why we don't mix up investments with life insurance, because you can't have both. I mean, you just can't. Now, in this case, this is 6%. All right, so let's say she only got 5%. 6% means you got to be invested pretty aggressively. So if we're going to do 5%, and if you only got 5%, then this account is only worth $95,000 after 30 years. I don't know. I mean, so for me, I would do the life insurance thing, because for a fact you're going to get, as long as you die before 97 years old, I want to talk about this for a second, that you're going to get a life insurance component to your heirs. B, you have access to some regard of the cash value. I don't know. I haven't seen the contract. I don't know what it is. The ones I used to do, Lincoln Money Guard, I think it was after 5. I can't remember. It's after 5 years. The entirety of the cash value is back 60 or something like that, was you could have it back if you needed it for sure. Now, if you took it out, you're reducing well, I don't have it up there. You're reducing the life insurance, you're reducing the long-term care, but at least you had access to it. And then if you use it for life insurance, or if you use it for long-term care, you have access to that. And if you died, well, the issue is, at least you get some money back, as opposed to what I'm doing right now, which is paying premiums, and no idea if I can get anything back. And I hope I don't, because I don't want to go to a facility. All right, now here's the thing that kind of concerned me a little bit. And Beth told me this, or Deb, what did I say her name was? Deb, Beth, Jane? I can't remember anymore. I think it was Deb. Did I say Deb? All right, she told me this at the very end, that is only until she's 97 that if she didn't die before 97, the contract would go away. Now, here's the concern I have. That means it's not a whole life policy. If there is a age limit where you have to take the contract expires, that means it's not whole life. That means it's universal life. Now, here's my concern with universal life. Are they saying it's good till 97 based on current assumptions, based on midpoint assumptions, based on guaranteed assumptions? There's three things when it comes to universal life insurance. There's current, there's midpoint, and there's guaranteed. So the guaranteed will always be the worst scenario. Not likely, but I mean, you're putting your hope into insurance companies, and you're saying, hey, it's not likely, but that doesn't make me happy. The midpoint and the current. And guess what it is? The current's the best under the current circumstance, the best under today, and that's halfway between there and halfway between there, midpoint. So her agent is saying this is good until you're 97. Well, I can almost guarantee you they're not using this as a guaranteed assumption, because no agents ever do that. Because if they were to use it as a guaranteed, it doesn't look as good. It doesn't sell. You got to sell the sizzle. And so I would have to ask Deb what that by that 97. I don't know, and she needs to find out. Like, wait. It's good till I'm 97 under what scenario? I mean, I'm telling you, if his whole life is good for your whole life, you don't have to worry about it. In this case, it's a dump in $22,000 with these various riders, but only until she's 97. Is that based on your guaranteed? Is it based on the midpoint? Based on the current? I can almost guarantee you it's based on current. Which in of itself is not bad, but just means, what if things change? Have we ever seen that before? Oh, all the time in life insurance policies. I cannot tell you how many life insurance policies are going to blow up before you do, and thus you thought you had $1 million life insurance and you don't, because there's not enough interest rate that you're getting on your cash value to keep the policy in force. I have to do another video on this because it actually is a huge pet peeve of mine. And so what happens now, because the current rate, we'll say 5%, and let's just say they drop to 4%, all right? Well, that's based on this right here. That not staying until 97 is based on that 5%. If rates drop to 4%, this goes down to 89. Now you're 89 years old, Miss Deb, and the insurance company says, look, if you want to keep this policy in force, you got to drop it another $30,000. And she goes, well, hell's bells. I don't have $30,000. I was supposed to be using this for long-term care coverage. I said, sorry. Not a good answer. So anytime there's a possibility that the life insurance policy could lapse, that's, in my opinion, I wouldn't do it in that case, because that means there is a lot of different things that have to go right for this policy to work out. At least with a whole life, you know for a fact, all you've got to do, you have to deliver your premium, and then once you do that, it's a unilateral contract. You are off the hook for any part of the contract. They are on the hook for the rest. I'm a fan of the whole life. I'm not a fan on this right here where it could lapse at 97 years old. That's not good, because I'm telling you, I've seen this so many times about policies that people thought they were getting that was guaranteed. It was never guaranteed. It's only guaranteed under the current rates. Or I hate to, no one's going to say, I said it was guaranteed. No, it's only under the current rates. And the current rates have changed. And when the current rates change, have you kept up with your policy? And the answer is no. 99.9999% of the time you haven't. And so that way you're relying on your insurance company to tell you, insurance company, well, we emailed you. Yeah, I get stuff from USA every day. I don't check all that stuff. That's USA. Yeah. Anyway, so that's how it can work. Without knowing the exact scenario of that, I just, Not a fan. I'd rather have a drop-in policy that's guaranteed for life, for sure. All right. Anyway, so I hope this helps. That's long-term care rider on a life insurance contract, a cash value life insurance contract. I'm a fan of them, but I'm a fan of them to the degree that they're guaranteed without you having to come up with the table with any more money. And this doesn't seem to be the case for me because it has a 97-year-old, age 97 lapse potential, which means it's universal life. Not a fan of that at all because things can change, as I've seen happen time and again. All right, as always, smash, subscribe, say your piece down below, and share the video. We'll see you next time.